and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. But this episode is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies. Perfect for diversifying your equity and bond portfolios previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. And as I said, today is the CPI report. And this is sort of a difficult one to do in a sense, because of all the other things that are sort of happening in the world and happening with the markets. You know, we've experienced a lot of volatility, and I think people overuse the term crash. You know, if you're of a certain age, you've been through a few crashes, you know what a crash looks like. This isn't a crash. But it is true that if you measure by, you know, the size of the range of the S&P 500, we've had more big range days over the last, you know, in a row than we've had kind of maybe ever. And so there's no question that this is sort of, at least on some level, unprecedented volatility. Now, the overall level of the market hasn't gone down a ton, but it's in this context that, you know, with markets moving like crazy, that we get a report like this. And because of those markets and because of tariffs and tariff uncertainty and sort of what's happening in the economy as a result of those tariffs, the CPI report has moved, I won't say it's moved to the back burner necessarily, but it's no longer sort of at least this month, it's not and even last month, I guess, it's not sort of the top of mind. This is the only sort of thing that we're concerned about right now, which is healthy, and we shouldn't only be concerned about inflation. What's sort of unhealthy is the focus on the stock market. As sort of representing the economy is both unhealthy and incorrect. So while this doesn't directly affect, you know, today's CPI report, I do want to say that it's important to remember that the economy and the stock market are different things. I think policymakers in general tend to look at, and Trump in particular tends to look at the stock market as sort of voting on whether or not the world, like, you know, the market likes his policies, and in a sense, I guess that's kind of true. But what is not true is that the stock market moves don't necessarily translate into this is a recession, this is an expansion, and so on. When the stock market drops, say 5 or 10%, you have to recognize that the price of a stock is sort of the fortunes of a company, specifically the earnings of that company, times the price per earnings. And so when you aggregate that, it's still true, right? So you're not trading the economy. If you look at the market as a whole, you're trading the economy times the price of, you know, per unit of the economy. And when you have large moves and lots of volatility like this, what's changing is not the trajectory of the economy. That has not changed in the dramatic fashion that the stock market has changed over the last couple of weeks. What's changing is the price that people are willing to pay for that piece of the economy. And as you get more uncertainty, the price people are willing to pay for anything risky goes down. And that's well established. There's strong theoretical backing for why that should happen. If you've ever been to a casino and you're familiar with betting strategies, that makes perfect sense as well. As you add uncertainty, then you sort of, you know, decrease the amount that you're willing to put at risk, which translates into a lower price. So that all kind of makes, so what's happening in the economy may or may not be, well, we're going to get a technical recession at least just because of what's happened to the trade balance in the first quarter and the beginning of the second quarter. But in terms of actual large job losses and so on, you can look at this 20% pullback in stocks and say, oh, we're going to have this big recession. Millions of people are going to lose their jobs. Just because those things are often correlated, obviously the stock market went down a whole lot in the global financial crisis and went down a whole lot in the post-internet bubble, and those were both correlated very highly with fairly deep recessions. It's not necessarily true that every time you have a pullback in stocks that it means a recession, or that the depth of the pullback is directly related to how deep the recession is. In this case, because the market was highly overvalued and has been for some time, an injection of uncertainty into the system is going to mean lower prices, all else being equal. And by the way, I think that's healthy. So, and it's good for people who are going to be investing for the next 10 or 20 years to be able to invest at lower prices rather than higher prices. So I think that, again, while the economy is going to have some growth, have some weakening, probably bump around here a little bit while everyone tries to figure out how the tariffs affect each individual company and the economy as a whole, it's not, we're not falling, the economy isn't falling out of bed, even though the stock market's falling out of bed. Anyway, that's sort of a big preamble. I often have big preambles, but not necessarily on CPI day. I want to get to the CPI report, of course, and which was interesting in and of itself. So we went into the report, and everybody was kind of looking for a little bit of a soft number, core, maybe a 0.25 or something like that. It was, remember last month we had like 0.23, and it was a positive surprise. Everybody was really happy at how soft it was. And then you kind of looked at it, and median wasn't really that soft and whatever. So people were looking for a bona fide soft core CPI, and headline CPI of just a tenth or so. And in fact, the number was softer than that. And so the thing, first prints and you see, okay, it's, we have headline inflation at, minus 0.05% month on month. So actual deflation in March. And core inflation, which means headline inflation is only 2.41% over the last year. You can expect to hear about that from the president. And, but again, we sort of thought that headline would be a little bit soft because energy was softer than the seasonal adjustment factors accounted for. But core, more interesting was that core inflation was sharply lower than expected. Core inflation was only up 0.06% month on month, when we'd been expecting about 0.2 higher than that, and the year on year down to 281. That's far below expectations. And so, ordinarily you look at that and go, wow, this is really exciting. That's great. We want to see disinflation. That's a good thing. Trump said he would bring down inflation, and look, it's happening. But it turns out that it's not quite all that. Again, there's a reason that we follow median inflation, and the reason I always advocate that what you should be targeting and looking at is median inflation and not core, because in core inflation, which is a simple average, you can have a large move in a tiny weight, and it will affect your overall core inflation, but it doesn't really reflect the actual what's going on in most of the economy, right? It's only you've got this one little tail event. So the median gives you a better sense. And in median inflation this month was, we're still waiting for the official number, but my forecast is 0.35% based on the numbers that came out. Now, the median category is probably going to be, or at least several of the regional housing sub-indices are clustered kind of around the 50th percentile. So it's going to be one of those. And so depending on how the Cleveland Fed seasonally adjusts those different sub-indices, you're going to get a different median inflation, but it's not going to be very far from 0.35%. And 0.35% would actually be, if it was that high, it would actually be, the highest in over a year. So, but sort of in the general range, where 0.3, 0.33, 0.35, and that's kind of where we've been for a while on median inflation. And so you look at that and you go, all right, well, I guess there's obviously something going on in core, and it's not housing, because if it was housing, then median inflation would also probably be a little lower than 0.35, right? It would droop a little bit. It wouldn't droop as much, but because housing is such a large part, if that was kind of the one-off we were having, like we did kind of middle of last year, then you'd also see median drip a little bit. But you didn't see that at all, which tells you this is all tiny categories with big moves. And in fact, that's exactly what happened. So, and it was kind of just a parade of the usual suspects. Used cars and trucks was down 0.69% month on month. We'd actually been expecting a small rise in used cars, so that was a little bit of a surprise. Airfares, which last month fell almost 4%, basically 4% month on month, fell another 5.27% month on month this month. Now, some of that's jet fuel, but that's a lot more than we would expect from just jet fuel. So in 2 months, airfares are down, 9.25%, which is a lot. Lodging away from home down 3.54% month on month, and it was a small increase last month. Car and truck rental down 2.66% after minus 1.25% last month, and then medicinal drugs down 1.3% month on month. So, starting at the end there, I've talked about medicinal drugs. Actually, 2 episodes ago of this podcast, I talked about the most favored nation clause and why there's some reason to think that just to sort of help get Trump on away from the most favored nation idea, that maybe pharmaceutical companies would bump up their drug prices kind of early in the year, so then they can kind of moderate it and they can come down a little bit. So not super surprising it's down. That's not going to be sustained, though, because as of at least this podcast, the administration has deferred a lot of the tariffs. There's still going to be a 10% tariff on kind of everybody, but the tariffs on Chinese goods are over 100%. So major trade war with China, and one of the things that we get from China that we can't easily replace, but we will replace it, but we won't be able to replace it right away, is the advanced pharmaceutical ingredients, the APIs. Is it advanced pharmaceutical APIs? I always forget what the A stands for. Active pharmaceutical ingredients. Sorry. Most of that comes from China. And so when the APIs are going to be, doubling in price, unless they get some sort of exemption, that's going to have some effect on medicinal drugs. So that's definitely going to go up. The used cars and trucks, private surveys had shown that prices went up, so it's a little surprising that they showed up as down in this month's report. The private betting markets had used cars up. Lodging away from home is interesting. I do think that there's a part of that that's probably real, and a part of that that's it's probably, in a way, it's probably all real. On the one hand, we know that there's been a recent decline in tourism to the U.S. And, well, maybe that's a political discussion, but whatever. There's been a decline. And at the same time, when the administration has started deporting lots of illegal aliens, I've said it a number of times that one of the immediate effects that you can expect is that should have a dampening effect on shelter prices, because if you have fewer people to put a roof over, the price of roofs is going to go down. And the place we would expect to see that immediately is in lodging away from home, in hotels, because that's where a lot of illegal migrants, particularly under the Biden administration when they were more or less welcomed, where they ended up. They ended up in many of these cities. They ended up in immigrant hotels, and that caused overall hotel prices to be higher than they otherwise would be. And as those hotels get emptied, then hotel prices will go down. So I don't know how much of this is a tourism effect. I don't know how much of it is an illegal alien tourism effect. But there's a chance that that's actually kind of a real effect. And I say I'm calling this a real effect as opposed to a fake effect or a mean reversion effect. Those categories that I named, medicinal drugs, used cars and trucks, airfares, lodging away from home, car and truck rental, I guess used cars and trucks a little bit less than the others, are kind of mean reverting sorts of things. Used cars and trucks mean reverts, but over a much longer period. But airfares goes back and forth a lot every month. Lodging away from home bounces around a lot. And so ordinarily we'd see numbers like this and we'd say, oh, okay, I'm going to assume that we get a give back next month. Don't necessarily know how much of that is going to happen. But bottom line is, outside of these small weight categories that had big moves, the median CPI being 0.33, 0.35, wherever it comes in, tells you that it was mostly there. Outside of that, there wasn't a whole lot of inflation going on. Now, because of the effect in medicinal drugs, because in used cars, we actually saw a significant drop in supercore. So it's core services. Well, actually, the ones I just named are core goods, but airfares and lodging away from home, core services x rents. So that's supercore, right? And we saw actually that was down 0.24% month on month, which was the sharpest decline since COVID. And in fact, I guess about the fourth sharpest decline in the last 20-something years. And year on year, that category, and again, the supercore is sort of where it's kind of that wage feedback loop, the price wage feedback loop kind of operates. We've seen median wages have been actually pretty steady at 4.3% year on year. So that makes me a little skeptical that this decline in supercore is real. And there's some other reasons to be concerned or to be skeptical of that. One of the other reasons to be skeptical that decline in supercore is real is that if you look at the other kind of three spikes that were similar or greater, there was the one in COVID and there were two others that were of similar magnitude, and all of them were in March or April. And what that suggests to me, especially because you have like lodging away from home showing up in there, is that it could be an effect from the moving around of Easter/spring break. It's just sort of suspicious that every time we have this big dip, historically it's been in March or April, because that's when Easter and spring break falls. So that could be a seasonal adjustment issue. It's a seasonal adjustment issue, by the way, you can't really escape because we can't analytically address, or economists don't have sort of, I guess, the tools to easily sort of address that in a systematic seasonal adjustment thing. We can sort of make ad hoc adjustments, but it's sort of hard to do that in a systematic way, rather than as sort of a one-off adjustment. I think that part we're probably going to get a bunch of that back. Again, I think that, and so some of that would be the airfares too, right? So I think we'll see, but I think that at least some of that we're going to get as sort of a rebound. And I'd like to think that it was good news, but I'm a little skeptical that the supercore news is as good as it looks. Hey, if it is, that's great. In the meantime, we have median inflation kind of still converging around the three, and it's still 3.5 year on year. And so we're kind of mid to high threes right now. One other little thing to note is that food at home. Okay, so there's food away from home. That is that's non-core. Okay, that's mostly wages because they're restaurants and stuff like that. Food at home is in the food and energy group, and so that's kind of the first thing we take out of CPI. Take out food and energy, then we look at core, right? So the reason we take out food and energy is that there's a lot of noise and not so much signal. And so if you really want to figure out where inflation is going, then the first thing you do is take out food and energy. That leaves you with core, which, as I've noted, has some other issues. But at least overall, core is more stable than if you look at the overall headline number. But anyway, food at home is important because of the salience of those categories. And what I mean by that is, even though eggs is a tiny, tiny percentage of the consumption basket, we've noticed the price of eggs, okay? And it has entered into the national discussion. By the way, eggs were up 1.8% or something month on month. On the wholesale level, egg prices are dropping quite a bit, but it'll take a little bit for that to be factored into retail prices. However, we've noticed egg prices, right? Meat, poultry, fish, milk, cheese, all of those are inflating. And so even though those are really tiny weight categories, we've kind of sort of noticed them. And so food at home was up 0.49% seasonally adjusted this month compared to just 0.01% last month. And on a year-on-year basis, if you sort of look at it, there's sort of this, over the last year and a half or so, really, we've started to see this slow acceleration in food at home. And again, that's sort of concerning only because, yes, food at home, those prices are, classically mean reverting. However, the salience, they have a much bigger weight in terms of the fact that people notice them. Just like gasoline, gasoline has a fairly small weight in terms of the actual dollars we spend, but in terms of how frequently we spend those dollars, and so therefore how much we notice what's going on, gasoline has a really high salience weight, to the degree that if all prices are going down but gasoline prices are going up, and you ask a bunch of people what's happening with inflation, people will generally say it's going up because they'll basically just mirror gasoline. And food at home is sort of similar to that. So anyway, the big picture was you got a great core number, second great core number in a row. The backdrop is it's also the second or third or fourth or seventh kind of normal median CPI in a row. And we're at 0.33, month on month, kind of month after month in median. And in median, there doesn't look like there's any further strong pressure to lower inflation further from here, which is about 3.5%. Rents were actually, owner's equivalent rent and primary rents were actually a little higher this month, or they increased a little more this month than they increased last month. Overall, rents are still decelerating, but they're decelerating kind of to what the model says, 3 or 4%. So all these things are kind of converging on a level of inflation that is not alarming, but it's also not where it was previously. And so that theme sort of continues today in this month, even though we had this really great core number. So what does this mean for policymakers? So the first thing to sort of note, and actually I should make a general note, that over the next 3 to 6 months, we're going to have tariff effects coming in, and it's going to push month-on-month inflation numbers higher. Going against that a little bit, but I don't think enough that we'll really notice it, but the uncertainty lowers monetary velocity. And so what happens when people are uncertain about what's going on in the world is they tend to hold larger cash balances. And Larger precautionary cash balances means lower monetary velocity. That's a big macro effect. And I think that over the next 3 to 6 months, we're going to be looking at all these micro effects. We're going to be looking at the actual tariff effects coming through the numbers. And so I think that the macro effect is going to kind of get lost in all that. But that's kind of what the uncertainty is doing. In 3 or 6 months, once we've kind of gotten past the tariffs and we've gotten past the uncertainty, we kind of know what's going on, then that depressing effect on velocity will unwind at the same time that the upward effect from tariffs has already been realized and is in the rearview mirror. So I'm not sure we'll even actually really notice that part of it. But the other thing that uncertainty does, there's 2 other things. One is, I've already mentioned it, uncertainty lowers the fair price of a risky asset. But the other thing it does is, from a policymaker perspective, what it should do. Let's say what it should do. What it should do is, if you're a policymaker and there's a lot of uncertainty, the correct answer is that in order to make any policy change, you need to be more confident. You should have a much larger hurdle to making a policy change in an uncertain time. Okay, not lower. And I think that the Federal Reserve tends to respond to uncertainty by moving more quickly. And that's exactly the opposite of what you should do. Uncertainty means, that you're not certain about what the actual effects are. And the correct answer there is not to try to add a bunch of money. Let's not cut rates. Let's not try to soften the effect of the recession, because we don't even know there's going to be a recession. And in fact, my view is that while we're going to have some negative quarters of growth, that's because of imports trying to front run the tariffs. And I don't think we're going to necessarily see, big lines at soup kitchens. I don't think we're going to see a really, we'll get a technical, we're overdue for a recession, but it's not going to be a deep one. And it's not going to be the sort of thing that the Fed needs to cut rates down to zero for, or move very quickly to cut rates, period. I'm not really convinced the Federal Reserve is going to do that the right way. Having said that, the report card for the Fed over the last couple of years has been better than over the prior decade. They've avoided some of the big mistakes, and I've generally been happier than I expected. They still haven't done a great job, but they've done better than the disaster I was expecting in most cases. So maybe they will sort of look at this and say, what the right answer is, let's sit on our hands and wait till the tariffs are go into effect. Wait to see what the, not what the jobs numbers do over 2 months, but let's wait 3 or 4 months, 5 months. Let's wait and actually see what happens to the broader economy, and whether it looks like it's a shallow thing, and so we don't really need to do a whole lot. We could just let the economy do what the economy does, or whether it's going to be something more severe and we as policymakers want to try to cushion it. I'm not even sure that they're supposed to be doing that. But again, the correct response is the Fed should be doing less. The market is pricing in that they will be doing more. And so I suspect the market's right in this case. But we will wait and see. And in the meantime, that's all for this month's CPI report. That's all for this episode of Sense and Sensibility. And I appreciate you tuning in. And please subscribe, refer others, especially because next week we're going to have a very, very special announcement. I think next week's podcast is going to be really super exciting, and I'm looking forward to it. In the meantime, you can contact me at inflationguy@enduringinvestments.com. The blog that has the CPI report written down on it is at inflationguy.blog, and that's free. You can follow me on X at inflation_guy. And, most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.